Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I mean, one thing that we'll know that we can look at to return to normal is deal making, is fundraising. That'll be a sign that people feel comfortable, companies feel comfortable with the current market environment. And it looks like at least one person feels good about how things are shaping up. Bill Ackman has filed to take public his hedge fund firm, Pershing Square, and a new closed-end fund. At the same time, Bailey Lipschultz is Bloomberg News' senior equities reporter. He's been covering IPOs for years, and this is something we had been anticipating, Bailey, because there was this effort to list the hedge fund Pershing Square back in 2024 that didn't get very far.
Well, so back in 24, the initial thought process, from our understanding from Pershing Square, was we're going to raise a lot of money in a closed-end fund. So that way we can have an even higher fee base. We want to raise more than $20 billion. Then that number became like 10, then it became 5, then it didn't actually get off the ground. So that was for the closed-end fund. Now we're seeing them come back with this, I'll call it novel pitch, that if you invest in the closed-end fund, we'll give you some shares to the actual management company as a way to entice people to buy. Their pitch was, we had a few $1 billion in demand last time. We now have $2.8 billion in private demand. As long as we can bridge the gap to more than $5 billion in this closed-end fund, ups our fees, and also gives us something else to give investors, and it ultimately takes the company public.
So it's fee? What's the motivator here? Is it fees?
It's creating a vehicle.
He's pausing.
No. It goes back to kind of the pitch that
I'm just trying to assess whether or not like this is a sign of healthy markets and it's a good move.
It's something that they need to do. So point blank, Pershing Square failed to raise a handful of billions of dollars in a closed-end fund 2 years ago.
He's not coming at this from a position of strength, or is he? I know I'm really pressing.
I mean, maybe. Okay, things that we know. They wanted to raise tens of billions of dollars before. They did not. They had discussed potentially taking the management company public. Now with this process, both can happen potentially. Raising $5 to $10 billion increases the amount of fees that the company can generate, the management company, and it takes the management company public.
A lot of people know Bill Ackman as an activist investor. They think of Herbalife. They think of all these other companies that he kind of targeted, made his case against, or made his case for. He no longer really does that, does he?
No, it's pretty much holding a handful of companies. So whether it's Chipotle or Alphabet, Brookfield, like kind of buying a concentrated portfolio and holding it. He's also now even
like Warren Buffett, kind of using that playbook.
That's exactly what he's trying to lean into. Though a bit more vocal on social media with his views, which depending who you talk to is bullish or bearish, but really trying to cater with this offering to retail investors, point blank, is kind of the view of this pitch.
So now he's going to listen to retail investors and, run his
He engages
company.
with them, though.
He does engage. He shares a lot of things on social media.
I'm just still trying to wrap my head around why he'd want to go public with anything and then be open to so much more scrutiny and regulation or whatever.
Well, I think that's kind of the discussion going back to 2024 when they sold a stake in the company, Pershing proper. That was viewed as a way to start the process to going public. So there was always a vision to IPOing or taking public the management company in some capacity. And it does benefit by, if you're a management company and you're collecting a 2% management fee, the more assets you have under management, the more fees you have, the more attractive the company does then.
So what's the timeline now?
So base case at a bare minimum, you need 15 days from this filing before you can launch an IPO process. It takes about a week or so. When you look at the calendar, 2.5 weeks from now, you get closer to some of the holidays. So maybe this is something that we see starts to hit the road after the Easter holiday when people are back in their seats. But at a minimum, this process cannot formally start for at least 15 days. And then we'll move from there. But we're expecting it probably, just looking at the calendar, call it right on the other side of April.
Okay, again, I mean, some sign of confidence from Bill Ackman that he's moving forward with this in a period where there's a lot of uncertainty about asset prices, about the global economy.
And that's something that they kind of call out in his 8-page letter, basically saying that, most of the time, companies who are looking at IPOing will not go when there's volatility in the market. Their pitch is, well, if you're giving us money to turn around and invest, well, we should be buying low and then ultimately profiting from there.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Kohl, they had results. In fact, they reported worse than expected sales for the last quarter. They continue to struggle to revive years of declining sales. Let's figure out the Kohl story this morning. Mary Ross Gilbert, Senior Equity Analyst with BI covering retail. We actually, Mary, just did an informal survey in the studio. Charlie Pellet, the last time he was in a Kohl's was 10 years ago. Scarlet,
about 10, 12 years ago.
Yeah, okay. Me, actually, I do go there, but probably about 6 months ago. Who is Kohl's customer? I mean, clearly not us.
So, John, the Kohl's customer is largely a low to middle income consumer. And so I just went there yesterday just to see what the store looked like. And I did observe that their customers are definitely seeking value. You don't always see a lot of bags because they're in there carefully choosing, trying to find value. And so this is why the company has brought on deal bars. Those are $10 and under items. And now they've announced that they're also bringing in toy bars. So they want to also feature items, again, $10 and under, with different price points of like $4.99, $5.99, et cetera. So they're really trying to gain, traffic and conversion, but really they're also leaning into their private brands. So for example, I did observe that LC Lauren Conrad, which is their women's label, it's a fun label, and they did a great presentation in the store yesterday. The problem is that the rest of the store is still it's not really cohesive. So we're really not there in terms of where we need to be, where you can see a real cohesive strategy. And so we saw a lot of clearance in the stores as well. So they still have a road ahead, as you highlighted, with the 4 years of stacked comparable sales declines.
Yeah, that's quite a track record to have to turn around. Mary, according to a company presentation at the earnings, Kohl's admitted that it lost competitive ground during high traffic shopping windows, including Black Friday, Cyber Monday, and the week following Christmas. When I read that, I thought that was a fairly startling admission. How do you interpret that?
I wasn't surprised, candidly, because we were there on Black Friday. And I could see that shoppers were trying to spend, because you get sort of a free, the minute you walk in the door, you get a free Kohl's cash, and you scratch it to figure out how much cash you get. And trying to find a way to spend it was a challenge because there were a number of excluded items. And while they've increased the number of brands that are not excluded, there's still a fair amount. So there was some confusion, and not a lot of customers were walking out with bags, is what we observed. So we felt like, it was hard pressed, let's say, to find a way to spend the money. So they really needed to do a better job, and that's what they admitted, on finding values. And that's why they say that their margins this year, are going to be hard pressed, because they need to get the sales lift, right? They've done such a great job on managing expenses, and they'll continue to do so. But until they get the sales moving in the right direction, they're not really going to see that margin improve, because they do have to be more promotional, have sharper values. And so that's going to impact margin to a certain extent. But it's important so that they can be competitive, because we saw strong results in off-price, as you note.
You could hear me early this morning going, ouch, as I filled up the car. It was, what did I say, $3.60 a gallon. Did that come up in the call with the executives?
Oh, good question.
I mean, it's probably the last thing they need for their customers to be paying lots more for other stuff.
John, you're absolutely right. And this customer is really going paycheck to paycheck. And so when you do have gas prices going up, that's going to impact their discretionary income, and thus the importance that they really have those sharp values in the stores. So that's what they're hoping to achieve. They're really leaning into their private brands, and they've got a campaign by Kohl's, which features their brands like So for Juniors, and that actually did well because they really featured that heavily in the stores. We observed it yesterday. And so, I think, and that also helps on the margin side to a certain extent. But again, they really need overall sales to rise to really get margins to move in the right direction.
This is a company, as you pointed out, has been struggling for about 4 years with same-store sales, not performing very well. You just look at the sales growth over the last couple of years, and it's a bunch of negative numbers starting from 2023 on. What is needed here to really change the trajectory of Kohl's? I mean, how much longer can it go in this same direction before it becomes a candidate for takeover by another company or by private equity? Or, something needs to change, perhaps.
Scarlet, yeah, you raise a valid point because when you think about it, they do have a juicy real estate portfolio, so that might be attractive to some strategic buyers potentially. So there could be some interest here. We also think that with over 1,100 stores, do they really need to be operating that many stores? They did say on the call that they have no plans to close or open any stores, really. They might have a replacement store here or there, but their objective is really to get this box more productive and also raise digital sales. They really want to take advantage and grow digital sales too. So it's really about reaching a point of stability on the top line. And so they're, like I said, leaning into private brands, and they have a number of initiatives, but it's going to take time. So they're already guiding toward comparable sales declines of about 1% to 3% in the first quarter. And when you look at the stacked 4-year comp decline they're going against or cycling, that's a 17% decline. So that shows you the magnitude of the decline, and that's even after gaining a $2 billion revenue business with Sephora. So that means that when you look at the declines in the rest of the business, it's much steeper than the 17%. And so that's a critical thing to note. And when you think about Sephora, their comp sales were flat in the quarter.
Yeah.
Previously, we were seeing increases. So that business has really matured at this point. And that's why they've got a number of initiatives there, bringing in more brands to really ignite and try to grow that business.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
When we look at all the volatility in the markets, it's kind of striking how much investors have to juggle in terms of the different factors out there and, the narratives that they need to contend with.
What do we call it? The confluence.
Confluence. That's a great word. Matt Griffin knows the confluence very well. Matthew Griffin is our Bloomberg Equities reporter, and he's one of the authors of today's big take story, which is about how market cracks are widening as war, AI, and credit fears are colliding all at once. Matthew, great to see you.
Scarlet, great to be on. Thanks for having me.
So the war in Iran just introduces a new shock into the global economy, one that already has investors feeling kind of nervous, kind of confused, certainly very uncertain about all the different things that are taking place, whether it's inflation, whether it is the jobs market, whether it's AI or private credit.
Yes. And what I would say about this is that it really means two things for markets right now. One is, even if the war ends tomorrow, even if oil prices go back down into the 60s per barrel, it's not all clear for investors in the way that maybe you think about last spring. Trump paused the tariffs. You have, the best day for the S&P 500 since 2008 because a lot of the headwinds facing markets just vanish. That's not true now when you have private credit concerns, when you have fears of AI disruption. And then another thing is that the war also heightens some of those other risks. It makes it harder to refinance loans, private credit loans that aren't working. If central banks can't cut rates, it puts more pressure on consumers. So it all just adds up to a really tough spot for Wall Street right now.
So what's the playbook?
Well, what the head of U.S. rates at Amerivet told us is the playbook is out the door. And I know that maybe isn't a definite answer, but I think everyone is scrambling to figure out what to do here. One thing that I, heard from an investor myself is diversification is really important because there's just a lot that isn't working right now. So you want to make sure you have some exposure to things that do, but I don't think there is a right answer.
One of the final quotes you have in the story is pretty telling. It's from Matt Maley, who talks about how a lot of people are not so concerned because they say, yeah, okay, oil is spiking, but it's not as bad as it was in the 1970s. Okay, there might be a bit of some lofty valuations in tech, but it's nothing like 2000. All these comparisons to previous contexts kind of give us a false sense of complacency, doesn't it?
Yes, and it comes back to the idea of the story. So Matt Maley's a strategist at Miller Tabak. What he says is you can't look at each of these risks on its own because the problems together can add up to create issues for risk assets, and also that the stock market is really expensive today. So that maybe creates more downside risk, even if the initial, issues are smaller.
So if a headline crossed and said the war is over, is it all back to normal?
I think that's what we've been hearing is not necessarily. I talked to investors and strategists for a different story last week that was about this question of will Trump and can Trump step in to rescue the markets in the way that he did last spring?
And the
Trump put, yes. And what a lot of people told me is they really weren't holding their breath for two reasons. One, the market hasn't been shaken as badly as it has been last spring. So the administration may not be at that point yet. Although you did see Trump, making some comments yesterday, signaling the war will end. But the more profound issue is that a war is not as simple to change as a list of tariff rates on a poster board.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.